Ladies and gentlemen, good day and welcome to the Emami Limited Q3 FY2024 earnings conference call hosted by IIFL Securities Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Percy Panthaki from IIFL Securities Limited. Thank you and over to you, sir.
Hi everyone, good evening and welcome to this Q3 and 9-month FY24 results call for Emami. On the call with us from the management, we have Mr. Mohan Goenka, Whole-Time Director and Vice Chairman, Mr. Vivek D, CEO, International Business, Mr. Gulraj Bhatia, President, Healthcare Division, Mr. Manish Gupta, President, Sales, and Mr. Rajesh Sharma, President, Finance and IR. I'll hand over the call to management for their initial remarks and then we'll open up for Q&A. Over to you, sir.
Okay. Thank you, Percy. Very good afternoon, ladies and gentlemen. Thank you all for joining us today. It's a pleasure to have you with us as we reflect on the performance of this quarter. Quarter 3 saw similar demand trends witnessed in Q2 with lower rural offtakes and demand from mass consumers in the low-income segment is still not picking up. Moreover, as you all know, the quarter experienced a delayed onset of winter with lower intensity impacting the demand for winter products. Despite these challenges, we delivered a resilient profit-led growth in Q3 of this year. Our consolidated revenues at rupees 996 crores grew by 1.4% with volume decline of 0.9%. Notably, while domestic sales remained flat, our non-winter portfolio grew by 5%. Navratna and Dermicool range grew by 7%. Pain management grew by 3%. Healthcare, excluding Chyawanprash and honey, grew by 3%. Overall healthcare range being flat for Q3. Helios and Brillare Science grew robustly by 80%. However, BoroPlus declined by 9% due to the late onset and mild winter. Male grooming range and case king range declined by 6% and 13% respectively. During the quarter, we launched Jhandu Agni Balm, a stronger multi-purpose balm to counter regional competition and gain shares from overall balm portfolio. Further, we also launched 5 digital-first launches during this quarter on our D2C portal, Jhandu Care, including an Ayurvedic toothpaste, Dantavir. Overall, we have launched more than 20 such innovative products on Jhandu Care platform in the last 9 months and around 90 new products since its launch, underscoring our commitment to diversification and innovation. Despite prevailing challenges due to currency depreciation in key markets, general elections in Bangladesh, continued political disturbances and crises around the Red Sea affecting the movement of goods, our international business also continued its robust performance, growing by 11% in constant currency terms and 8% in INR terms, driven primarily by the MENAP region. We also launched a pure glycerin oil under Creme 21 and a conditioning shampoo range under 7 oils in 1 in select international markets. Favorable input costs led to an expansion of our gross margin by 290 basis points to 68.8%. EBITDA at 315 crores grew by 7%, with margins expanding to 31.6%, a rise of 170 basis points. PAT at 258 crores also saw a healthy 9% growth, with margins expanding by 180 basis points at 25.9%. For 9 months ended December 23, our revenues grew by around 5%, accompanied by an expansion of gross margin by around 300 basis points, despite seasonal challenges. Our EBITDA grew by 11%, with margin expanding to 27.5%, an increase of 170 basis points. Our profit after tax at 575 crores also saw an impressive growth of 16%. I am happy to announce that our board has also declared a second interim dividend of 400%, amounting to rupees 4 per share for FY24 to reward the shareholders. The economic landscape is evolving favorably, with several key indicators pointing towards a promising future. The recent downtrend in inflation is a positive sign, and an expected recovery in rural markets, coupled with government impetus, would lead to strong growth ahead. Further, the announcement related to government focus on poor, women, youth, farmers, and increased allocations towards Manrega in the union budget, coupled with better than expected GDP growth in the last quarters, further fortify our confidence in the potential for improved growth. These macroeconomic factors, combined with our accelerated scale-up of emerging channels, distribution initiatives, D2C portals, Jhandu Care, strategic investments, innovation, pipeline, and ongoing investments in our core brands, are poised to drive growth going ahead. With this overview, I invite the questions. Thank you.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is on the line of Abneesh Roy from Nuvama Institutional Equities. Please go ahead.
Yeah, thanks. My first question is on the 5 D2C launches. So, what is the long-term potential either in the specific segments of the industry and from these brands? And you also are trying to improve margins in modern trade. So, last 1 year, how is the trajectory there? Have you arrived at the initial goal in terms of the profitability in this part of the channel?
Yeah. So, Abneesh, I will answer on the margin front. We have improved our margins on modern trade in the last 9 months. Though it is slightly not as we had expected, there is further room to expand margins in both e-commerce and modern trade. As far as the D2C brands are concerned, Gulraj is here. He will take this.
So we've launched new products in multiple segments in the D2C platform, covering healthcare. And as Mr. Mohan Goenkaji mentioned, we've launched around 90 products in the last 3 years and about 20 products in the recent current year, in the last 9 months. And we are seeing a scale-up happen of multiple products and multiple categories through the D2C platform. So we're very bullish on the digital-first products going forward, both in the current quarter and in the coming quarters. We've also launched a very potent and a very efficacious toothpaste called Dantveer, as you may have seen from the note. And we are fairly confident that we can scale this brand also up in the next few months and in the coming years.
So, few follow-ups there. Any D2C brand you have managed to bring to modern trade, and any synergy benefits you are seeing for D2C with Man company? And on toothpaste, that's very competitive, and Dabur, of course, is doing quite well in terms of naturals. And then there are two MNCs also. So, toothpaste generally is a tough category. I understand yours will be more of a D2C and natural, but generally it's a very tough category. So why toothpaste?
As you know, the toothpaste category is very large, and over the years, the Ayurvedic segment or the natural segment has been growing much higher than the normal toothpaste, which are non-Ayurvedic or non-herbal. So we do believe that there is ample scope to gain market share in this segment, even though the overall category may not be growing. And based on both the online segment in terms of the online purchases through various platforms, including Chandu Care, and our entry which we are making into the modern trade, we are fairly confident that while it's a competitive category, the kind of formulation we made, the kind of proposition we are offering to the consumers, we would be able to gain market share in this segment.
Sure. So also, Avnish, now that the margins are pretty high in toothpaste, particularly this Ayurvedic segment, we strongly believe that Zandu has right to win, because Zandu, in Ayurveda is a very, very well-established brand. And we were working on the formulation for quite some time. I think we have a winner formulation. So we have just launched in these channels for the time being, but I am very confident that going forward we will take it to the retail and the larger markets. Because margins are pretty high now in toothpaste.
Only one follow-up. In terms of positioning, how does this compare with Patanjali's Dant Kanti, Dabur's Red, and Ved Shakti of Colgate? So will this be more of premium given D2C?
It would not be at a premium like we would have other products in the category, because there is a certain price point in the category. But definitely in terms of the formulation, we got certain ingredients which are much, say, more efficacious. So we're not looking at it being limited to a very niche kind of audience. We want to get into the main market or the mass market. But we are doing the launch through online and through select channels which are emerging channels like modern trade. So we don't intend it to be a very premium or a very niche offering in that sense. It will be more mass market as we go forward.
Thanks. My last question will be on your Kesh King. Post-acquisition, first 1 or 2 years were tough, and then again it's been volatile, erratic. Now 13% dip in last 2 years, 3 years, you have tried to diversify portfolio also. So is this because generally hair oil demand conditions are tough? Is it because down trading is happening? So would you want to now make it more mainstream in terms of pricing? Will that be needed for growth to come back in this?
No, Avnish, we are not tweaking our pricing. Presently, you are right that hair oil segment is slightly struggling, and particularly Kesh King is a premium oil, so there is, some bit of stress. But, this, we have seen 1 or 2 quarters decline, then we suddenly see an upstick. So maybe the quarter 4 we will see some bounce back in Kesh King. This has been a one-off decline of 13%, but going forward it should bounce back.
So that is the issue. But when I compare pre-COVID annual sales to now FY24 annual sales, what is the CAGR you must have seen, and you have diversified portfolio also. So if you knock that off, obviously the core business would have seen a dip, right? Pre-COVID to now, full year sales.
Yeah, if you see last 4 years, Kesh King oil is at a 5% growth CAGR. When you compare pre-COVID levels, so this is one-off, a decline of 13%. It's not that the oil is declining, and markets are also tough right now for discretionary products like this. There is some bit of downtrading happens, because of price at what we sell.
Sure, thanks. That's also my side.
I'm not very worried. The onion and the other ranges that we have launched in Kesh King are doing much better. But once the market revives, I'm sure this should also get to at least 6 to 8% growth.
Okay. Sure, thanks. That's all from my side. Thank you.
Thank you. The next question is from the line of Shirish Pardesi from Centrum Broking. Please go ahead.
Hi, good evening, Mohanji. Thanks for the opportunity. I have few questions. The presentation is becoming now shorter. There are no mention about 7-in-1 oil. The volume growth also is not given. And more importantly, if you can give some more color, what is happening with the modern trade and e-commerce, because this number is also not seen in the presentation. So maybe if you can give some more overview how this has happened.
Just a moment, Shirish.
Hello, Shirishji.
Yes, Rajeshji.
Yeah. Seven Oils has also got impacted this quarter because of the discretionary overall getting impacted. So it is almost down by 5% this quarter. But for the full 9 months, if you look at, it is almost flat this year.
Okay. And what is modern trade and e-commerce saliency in this quarter?
So modern trade and e-commerce is more than 22% kind of, around 22%.
And growth?
So growth on those channels is also would be roughly modern trade would be around both would be around 10% modern trade growth, and around e-commerce is 15% kind of a growth level.
Okay. My second question to Mr. Gulraj Bhatia. On Zandu Online, though it is heartening to know that we have launched almost 90 new products, and we have been consistently adding more products. But if I look at last 2 years' experience, I think we started with 1.5% contribution. So give some more depth. Who are the typical customer who are buying? What is the profile? Because if the start has happened with the extrapolating the Ayurvedic substance, and we are adding the platform products on that, so how we should look at and think about the growth in the Zandu, fueling the entire Zandu portfolio?
Yeah. So, Mr. Padeshi, hi, how are you?
Yeah, good.
So, as you know, during and post-COVID, the online purchases of consumers in general have gone up. And in terms of the consumer profile demographics, they tend to be more of millennials, typically people between the ages of 25 to 35 years. They may not be buying these products for themselves alone. In the case of Zandu Care, they would be buying as caregivers for their parents or their, older sisters or brothers, etc. And in general, we know that this segment has been growing month on month, quarter on quarter, and there has been a large influx of new players also in the Ayurvedic segment. So we are seeing a good scale up of certain segments which we've launched in, and we are very confident that both in the coming quarter and the coming quarters, we will see many categories scaling up further in terms of the D2C platform. And it will extend not just on online, but it will also extend into emerging channels, as I mentioned, such as, for example, modern trade, both in terms of the regular supermarkets and the pharmacy chains also. We also do see a scale-up happening on the other e-com platforms, such as Amazon, such as Flipkart, etc., and the e-chain pharmacies also. So we are very bullish on the launches we've done. They took some time because, when you launch any product in healthcare, you have to do many tests internally and stability studies, etc. But now we got a certain critical mass to be able to scale up going forward. And we are already seeing that happen.
I understand, Mr. Bhatia. If I bring my marketing experience, you have been recruiting customers. Obviously, because of the online, the product is available, there is a recruitment of customers. But the question here is that the overall sales momentum is flattish. So I'm not been able to surely say that if this product extension and the new product has been able to get, because if I look at the healthcare business is flat, and this is despite our weak base also. So what is it that we are missing?
This is Shirish, because the Chyawanprash and Honey both portfolio.
Hello?
Hello, sorry to interrupt, sir. We are unable to hear you.
Yeah, but Shirish, that is primarily because the Chyawanprash portfolio has declined. The winter portfolio in healthcare has declined. That's why you are seeing flattish numbers. If you go product-wise numbers, the brands have grown at 5 to 7%. It is due to only the Chyawanprash that the portfolio is not growing.
Okay.
Yeah.
Sir, my
all of these are new launches. All of these are promising. They are certain. Some of them are large categories. At least we are, getting an entry into these categories now. We have definite plans, as Gulraj said. Healthcare has to grow at about double-digit growth. We are very, very confident. We are trying. If we have to tweak something after launches in e-com, then we might do it if we take it to the D2C.
Okay. My further follow-up on the domestic business, the volume, what is the volume growth we have seen in this quarter?
Volume is declined by 0.9%.
Okay, it's flattish.
Yeah.
Okay. And the last question.
This is again, Shirish, you have seen that we have declined by almost 9% in the winter portfolio. Winter is large in this quarter.
I understand, sir.
Yeah.
I understand, sir. That's why my last fundamental question is that over last 4 or 5 years, we are not lucky that all the 3 seasons has panned out well. So what is it that we are trying to do? I mean, we have seen a revival in the senior management also. We are now trying to gather the momentum with acquiring D2C brands, and now we are bringing in mainstream. So how we should build the next 3 years? I mean, seasonality is the part which we have been struggling. But in the management terms, what are we trying to address? Is this growth is always been dependent on the outside seasonality factors?
No, not at all, Shirish. We have come a long way. Our dependency on seasonality has reduced significantly. Okay. It cannot just go overnight. Our new launches are by and large non-seasonal. If you see our paint portfolio, which is almost 26% of our revenues, is non-seasonal. So barring Boro Plus cream and somewhat of Navratna oil and cool talc, these are the only seasonal brands that we have in our portfolio. Male grooming, Man Company, or these are non-seasonal portfolio. So we have come a long way, I would say, in reducing seasonality.
I agree, sir, but the question here is that if there is no price inflation which is going to be visible for next at least 2 to 3 quarters in the near term, is the volume growth will go to 5, 6, 7, 8, 9%? That's the question.
So aim is, of course, there, Shirish, that the volume growth should be in the range of about 6 to 8%, and that is what our aim is. You all are aware that market at right now is not the best market. The rural market is under stress. So there, winter has been under stress. So these are certain factors we have to keep in mind. What is in our control, we are only doing that. We are continuously premiumizing our categories. We are launching products. We are, doing what is best we can do. Okay. We have the kind of growth you have seen in TMC and Belair, in the last 1 year, the numbers have almost doubled. So there also, we have been very aggressive. And we have worked extensively hard to maintain our margins, grow our margins, despite of high margin categories at a decline. Boro Plus cream has declined, which is a very high margin category.
Okay.
So despite of all those factors, e-com, modern trade are growing very fast, which is again a lower margin compared to our GT. So there are multiple factors which we look at, and I think once the market momentum starts, I think we are absolutely geared to get into the growth mode.
And just last quick question on the pledge, any word where we stand today and what is the way forward?
Pledge is still at 12%, Shirish, and as I have said, we are committed to bring it down to single digits. I am very confident that I can't give on in which quarter, but management is committed that we will bring it further down.
Okay. All right. Thank you and all the best, sir.
Thank you.
Thank you. The next question is from the line of Harit Kapoor from Investec. Please go ahead.
Yeah, hi, good evening. I just wanted to have a question on the D2C part, Belair and Man Company specifically. Is some of the margin tailwind, a small part of the margin tailwind also that some of these brands have scaled up and, you're getting, going from, say, little loss making to, say, not as much loss making as well? So is that some scale benefit you're getting from there as well in the last couple of quarters?
Yes, Harit. So, Man Company, there is a big shift, which was a negative EBITDA margins has become, has become positive because our growth has been almost 80%. So due to the scale up, the brand is now, making profits. Same is with Belair. the negative EBITDA margins, which was in the tune of almost 40-45%, has come down to minus 20%. So there also we have, due to the scale, we are getting better results.
Significant investment. Great to know. The second part was on the material cost side. I think largely most costs are in a band now. I just wanted to get your sense on menthol. How do you see that playing out? Just any kind of outlook on that commodity, because it's fairly fairly unique to you in the listed space. So just wanted to get your sense on that.
Yeah. So Harit, menthol is also benign. There is no pressure on costs. It's not just menthol. I would say even LLP or the other key raw materials are also benign. So I'm not seeing any pressure as far as the input cost is concerned.
And just a follow-up, this is the last one on that, was, typically you have been used, pricing also as a tool to manage inflation, even OPEX inflation, and you've been very successful, hasn't really hurt your growth, etc. So in the context where inflation is kind of range-bound, benign, do you see next year also, some opportunities for pricing?
We will take a call as it comes, Harit. In the past, we have taken a price increase of almost 2 to 3%, and that definitely we always look at roughly around 3% of price increase. So next year also, hopefully, we should stick to those numbers.
Great. I wish you all the best, Mohanji.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is from the line of Percy Panthaki from IIFL. Please go ahead.
Sir, can you give us your thoughts on healthcare? I mean, this is a portfolio which we have been trying to sort of build aggressively over the last decade or so. And it's not just us, other players, for example, Dabur also has been sort of talking about this since the last 10 years. And whenever we talk to you or Dabur, we get the sense that this is the new growth driver. I mean, this is a segment which will grow like 2x of the overall company. But this has not played out that way over the last decade. So what is the reason that it has not happened, and what are the learnings for us which we can implement? And would you still sort of hold out that target that healthcare is the pillar or the driver for growth, which will segment which will be growing faster than the overall company?
Yes, Mr. Percy, we are fairly confident that we would be seeing strong double-digit growth in the current quarters and the going forward quarters and years, for the reason that in our case, our relative market shares are low across product segments. So it's a question of investing into these identified product segments to grow the market. At the same time, we are fairly confident that in terms of our product efficacy, our manufacturing capabilities, quality of products, and the fact that we are making a strong foray into the new age product segments which are doing well, both in terms of the online and offline go-to-market strategies, we are confident that the healthcare business would do relatively better than the other parts of the business, primarily because we have scope to grow our market shares. Because that gives us confidence that if we get the GTM right, we would definitely see a scale-up happening more than what's probably been seen over the last 10 years.
So is there something that we as outsiders, analysts and investors are not able to see in this industry? Because see, our cues that we take from the industry overall are just from these two companies, which is Emami and Dabur, which are in the listed space and we get regular information about. And if we take these two companies as a proxy for the sort of Ayurvedic or natural healthcare space, then that overall industry itself has not really grown, unless you're saying there is someone in the unlisted space whose growth is much higher, and that's why we are not able to sort of I mean, that's why the two companies are not a correct proxy for the industry. So what is really, I'm more trying to understand what has gone wrong in the past, and not for Emami, but for the industry as I understand it, so that then I can have a better understanding of what needs to improve in the future.
So as you're aware, apart from Dabur and Jhandu, there are other brands like Patanjali, there is Himalaya, there is Baidyanath. So if you look at the overall, pure healthcare, I'm not referring to healthcare as in, say, a toothpaste. That's not healthcare per se. But if you look at the core healthcare, especially in the Ayurvedic segment, I think the overall growth, as per my sensing, over the last maybe 6 to 7 years has been between 10 to 12%. So during COVID, as you know,
the unlisted players have sort of gained at the cost of the listed players, because the two listed players are not showing that kind of growth over a decade.
Yeah. So what happened is that during COVID, as you know, we saw huge growth happening, basically. So I'm looking at the COVID scenario also, where we saw growth upwards of 40 to 50%, at least in our business. Post-COVID, there has been a certain, as you know, diversion of the consumer funds, which have gone into more of the discretionary spends, more into travel, more into eating out, QSR. So we've seen that kind of a blip which has happened in the last maybe 2 years. So there's been a complete move away from the core healthcare products like immunity, etc. And within the 5 or 6 players I mentioned, some of the players have not done so well in terms of the overall business. So there's been a certain market share gain which is happening across the category. And in the online space, there has been a fair amount of activity which has happened over the last 3-4 years. So there are players who come in. We are obviously not able to quantify what their numbers are. But so the traditional channels, if you look at the pharmacy channels, etc., or the Ayurvedic stores, would have seen a 10 to 12% growth overall. But the online segment, in my view, would be growing at upwards of 25 to 30%. Because the niche offerings or because the specialized offerings. So we do believe that going forward, we have to understand the trends which are happening. There is also a certain move happening in terms of chronic diseases, diabetes, bone health, cardio. So there are needs, or there is a requirement for specialized offerings in these segments. Even the services segment is picking up, whether it is wellness, whether it is panchkarma, whether it is other forms of treatment. So this segment will continue to grow, in my view, upwards of 12 to 15% between offline, online, and services. And we are making plans to be getting into the relevant segments for us, besides, obviously, as I mentioned, growing our market shares.
And just a follow-up to your comment on the market share potential that you see. So can you just very briefly explain what is the competitive landscape here? What is the Pareto in terms of the top 5 players versus the long tail, etc.? And where is the market share gain going to come from? Is it mainly from some very fringe kind of a players, or do you think that the kind of products you have, they compete more with the larger players, and therefore if there is any market share gain, it will be from the larger players only?
So if you look at the 3 broad segments, one is the OTC business, products like Chyawanprash, honey, etc., Kesari Jeevan, Lithium, Vigorex. The second segment is the pure medico marketing, which is going to the Ayurvedic doctors and others. The third is the D2C segment. So in the OTC segment, we have a very large brand called Pancharishna, which is a very unique product, as you know. So there we define the category. So to that extent, in that category, there's been a bit of a slowdown post-COVID. But we have ample scope for growing our business or our share in the relevant other categories such as vitality segment, supplements, etc., where we will be competing with the larger players. We are not competing with the fringe players because they are relatively small. And if you look at the medico part, there we would compete both with the larger players and the smaller players. What's happened in the last maybe couple of years is that in the medico segment, the smaller players are also making forays into various states, various regions, etc. So there we compete both with larger and the smaller players. And our strengths, by way of our manufacturing facilities, in fact, we are the only company which has 2 WHO GMP manufacturing units. So we tend to be at a slightly or at a much higher cost than some of the non-compliant players. So there we would again be competing more with the larger players. though the market shares of the larger players are being eaten by the smaller players. And in the D2C segment, I think over the last 3 years, whatever work we put in, I think we are poised to reap the benefits more than other players. That's why you'd see the digital first products in the D2C segment for us doing relatively much better than both the larger players and the smaller players who got into the market in the last 2-3 years, basically.
Okay. Thank you very much. Operator, we can go back to the queue.
Thank you. The next question is from the line of Anurag Lodha from Axis Capital. Please go ahead.
Hi. Am I audible?
Yeah. Please go ahead.
Yeah. So I just wanted to ask you, the ETR has come in at about 7.7% for a 9-month period. So can you guide us as to what the ETR for the full year would look like?
What is the, sorry?
The full year ETR guidance, effective tax.
On tax rates, so we can expect similar kind of tax rates for Q2, quarter 4 also, and next year also around 10% would be there, considering the MAT credit entitlements we are entitled to.
Okay. And so can you tell us about the cash balances that you might have?
So we have roughly 400 crores of net cash available with us, and we have just announced second interim dividend today.
Okay. All right. So, yeah, thank you.
Thank you.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is on the line of Ajay Thakur from Anand Rathi Securities. Please go ahead.
Hello. Yeah. Hi. Thanks for taking the question. So,
sorry to interrupt. Mr. Thakur, your audio is breaking up.
Hello. Yes, Diana?
No, sir, it's still breaking up. Mr. Thakur, we are unable to hear you. We have lost the line for the current participant. If you wish to ask a question, you may please press star and 1. As there are no further questions, I now hand the conference over to the management for the closing comments.
Thank you, IFL. Thank you, Percy, and thank you all the participants for joining us this conference call on our Q3 results. Thank you.
Thank you, members of the management team. Ladies and gentlemen, on behalf of IIFL Securities Limited, that concludes this conference call. We thank you for joining us, and you may now disconnect your lines. Thank you.